Alrighty, what's up, guys? Good morning and happy Monday. Let's do a quick sound check in the free room. What's up, Lee, Mirza, Lorna? Yeah, Lee, I am getting ready. The home stretch. But all right, guys. Today's prep could be pretty short. As far as what I think we should really focus on, but we'll kind of cover all the bases. So what I do with the mastery group on Sunday is we kind of put together a scorecard for the market for the week ahead. Let me fix that. All right, much better. So for the scorecard here, for the week of 9/19, we got a lot more points for the Bears. So points for the Bears, you've got the bullish daily squeeze in the dollar. You've got HYG looking like it wants to go down towards the June lows, which basically means the market does the same thing. I think VIX is poised for a breakout above 28. And then on Friday, we got that gap down, which of course gives your S&Ps and the QQQ close under key support. We've also got some negative moving average crosses on some really important daily charts. We're going to take a look at all of this. And now we're starting to see the leaders break down. Points for the bulls, the market's a little bit oversold. And remember, oversold can become more oversold. So it all kind of points towards the bulls, or the bears rather, excuse me. They got control of the wheel for now. But as far as the dollar goes, I'm going to go through everything here. Pretty straightforward. As long as we have this bullish daily squeeze, bullish meaning you're above that 21 EMA and you have the big three buy signals, that bad boy is gearing up for a push towards the upside. So strength in the dollar typically means weakness for, the equities market. So for the bulls here, ideally for the bulls, they want to see this daily squeeze fail to break out to the upside and actually fire to the downside. If you could get the dollar under the 50, does a lot of good for the bulls. But for now, that looks poised for a nice breakout. So as long as you got that bullish daily squeeze in the dollar, it's a big point for the bears. And for HYG, look at this as like a compass of where the market is potentially going to go. So when HYG bottoms out back here in June, July, basically at the same time, the market did the same thing. So for now, you get these big pops towards that 21 EMA. That can be good to play the market to the upside for a few days. That rejection and the move right back down just kind of points towards HYG wants to take out those lows, which basically means your market will do the same thing. So for the bulls, they want to see HYG, back above the 50 SMA. Basically cancel out all these sell signals. So that's a point for the bears. And then the volatility index. I think the bulls, you want to see the VIX back under 24, 23. Otherwise, kind of looks like that daily squeeze is poised for a push through 28. And I kind of think, guys, above 28 pretty quickly, you could see the VIX back towards 30, 35. And I would think at that point, you're probably seeing your S&Ps and your Qs going back towards the lows. So 3 points for the bears right there. And, in the event you're bullish on the market, you're looking for the opposite. So if you're bullish on the market, you want to see the BIX, You want to see the VIX fail to break out above 28 and ideally pull back towards 24, 23. If you are bullish on the market, ideally you want to see the dollar really break down, like under the 50 SMA, basically start to cancel out this trend. And if you're bullish, you would want to see HYG, rally to the points trading back above, I think ideally the 50 SMA. Now, as far as the market goes, a lot of problems here, guys. So I think the simplest game plan for the next couple of days, couple of weeks, S&P's under 390, you want to short every bounce. Under 390, which is your key support that you broke on Friday, there's not too much to save the market here until you're back down here towards 370-ish. And I do think bigger picture, I think we could trade much lower than the June lows, but it's a pretty good target for now. So as the S&Ps are kind of hanging out here in, like no man's land, I think the bulls' only hope is that they really quickly rip the market back above 390, back above previous support. And I think, yeah, if they can do that, they can probably trigger a short squeeze. Everybody who got short on Friday, probably going to feel a little bit of heat on the move back above 390. But at this point, you've got the dollar, the VIX, HYG, you've got broken structure. Everything kind of points towards path of least resistance is certainly down towards the June lows. So the bulls have got to throw a Hail Mary here and very quickly get the market back above 390. And pretty much the only point the bulls have for now is the fact that we're pretty oversold. So anchor to that key level of 390. And again, oversold can quickly become oversold and more oversold. But being that we are, we're not that oversold on the hourly chart. But the point being, if we do get a pop here, if that pop doesn't take the market and keep the market back above 390, I think you short that pop. So you got the S&P under key support, and then also notice how the bars go from blue to gray. That means we got the negative moving average cross. So now the 21 EMA under the 50-period simple SMA. So it's kind of a path of least resistance thing. 21 breaks the 50. It's a little bit easier for the market to trend lower. If the 21's above the 50, a little bit easier to trend towards the upside. So you got all that going on there for the S&Ps. And I'm pretty sure we covered this a few weeks ago, but while we're here, as we're operating, Monday through Friday, we're doing all our short-term trading. Don't lose sight of the fact that the monthly chart has the first negative histogram since 2008. It's really, really important as far as the bigger picture. COVID didn't even bring that negative. Even the COVID flush didn't cause the histogram to go negative. That's a really big change to a really big trend. And for the QQQ, we're 3 months into seeing that negative histogram for the first time since 2008. So as the daily charts break down, as the weekly squeezes get a bit bearish, bigger picture, don't lose sight of that either. It's a really big shift and a really big trend. So food for thought there. But for the Qs, it's kind of the same thing. Negative moving average cross. The Qs are actually in worse shape because they get a bunch of sell signals here. But you got your negative cross and you're under key support around 290. So same mindset. The bulls can't quickly get the Qs back above 290. And mind you guys, that doesn't really fix all the problems. We could rally back to the 21 EMA and then puke again. But in the short term, just like the S&Ps, the Qs are in no man's land. There's not too much support here until you're back down towards 270. So under 290, I think the Qs are a short. And what I think could actually be a little bit easier about looking for a short on a pop here is actually that off chance that they do trap the shorts and trigger a pretty big short squeeze. Meaning the S&Ps pop a little bit today. You buy some October, November, December expiration puts. And then in the short term, they actually get it back above 390 and trigger a little bit of a short squeeze. The worst thing you can do in that scenario is kind of sit there, and take it on the chin. The best thing you can do is anchor to 390. Look for some November, November, December puts under 390. But then in the short term, if we actually get a move back above it, buy a couple of cheap calls. Play that move maybe back towards 400. With that kind of volatility, you can pretty quickly cover your short risk. So that's the thoughts on the S&Ps and the Qs. And then, probably the biggest point here for the bears. Here's kind of the theme. The first thing that they kill, I'm trying to think of a friendlier term, but it is what it is. First they killed all the COVID heroes, right? Your Zooms, your Pelotons, your Pinterests. to an extent, those have all kind of been taken out on the old woodshed. Piton, right? You got Pinterest, so things of that nature. Now, the last couple of weeks here, we're starting to see things like the semiconductors. Semis are back down at the lows. Nvidia is actually making a new low. I think AMD is pretty close to making a new low, right? It's getting there. So they take out the junkier stuff. Then they kind of start to take out more meaningful things, and then you've got your leadership. Your Amazons, your Apples, your Googles, your Microsofts. Right? So check out Microsoft. Already back down at the lows. Google, you hate to see it, right? Poor Google. Google at a brand new low. And mind you, this is all before the S&Ps and the Qs are even back at their low. The S&Ps and Qs have got a good 5-6% between Friday's close and the June-July lows. So the point I'm trying to make is imagine what Google looks like. The S&P 500 and the QQQ pulled back 6% from here. Probably a lot uglier, right? Then you look at things like Amazon. This is, to me, where it gets interesting. They kind of took out like the ARC stuff. They got Nvidia at a new low. AMD's getting there. Google's already at a new low. Microsoft's at the lows. But the S&Ps haven't even gone to the low yet. The Qs haven't even gone to the low yet. Amazon has a good 25% before it's back down there at those June, July lows. Right, so understand the correlation. Amazon's a really, really important stock as far as the weighting. And then what about Apple? 150 to 130, what's that? A good 15-ish%? So understand the correlation there. Apple and Amazon alone make up a huge chunk of your SPY, your QQQs, your XLKs. So the way I'm trying to get you thinking here is like if-then statements. If Apple pulls back 15-ish% to the June lows, and Amazon pulls back 20+% to the June lows, do we actually think the S&Ps pull back a good 5% and just stop? Do we think the Qs are going to pull back a good 5 or 6% and just stop at those lows? Probably not. Google's probably going to go much lower than 100. So just really important things there. With all that being said, in these downtrends, in these bearish markets, you're going to get your craziest rallies. Well, I do think we're going to trade much lower from here. It's kind of like a point A to point B thing. Here's point A at 390. There's point B at 380. Along the way, there's going to be some crazy ass moves. So as I say all these things this morning, always be a bit careful in terms of how you're getting short when we're a bit oversold. I don't think you want to short in a fashion where you buy some puts on the S&Ps today and it starts to rally back towards 390. Don't let that take you out of the game because there's a decent chance here. A couple more things here as far as today. Clean up all the drawings here. Key support for today, Friday's lows. Pretty straightforward. Not too much here to save the market as far as technical support. So we're basically looking for the market to potentially create support along the way. So for your S&Ps, your Qs, etc., you anchor to Friday's low. Now with the futures here, we are trying to get a bounce going off of Friday's low. So the Qs are down about 0.7 and the S&P is down about the same. So for now, we've got in the options room, we got some call credit spreads on the SPX and some QQQ puts And in the mastery, we got some call credit spreads on the SPX and the SPY. Now, guys, as far as playing the upside here, that's where it all gets a bit tricky. Like, here's a good example. Actually, probably the best example. Tesla's basically the only, major name, let's say, still holding up here and looking bullish. So add that to your watch list. If Tesla breaks down, like you're under your 21, you're under your 50, I would have to think the market really gets hammered. Because Tesla plays a pretty big role as well. But as far as like what makes a great swing trade, and remember, it's all just like probabilities based. I think the best swing trades are when the stock, the sector, and the market, like the S&Ps and the Qs, when they're all perfectly aligned. So what do I like about Tesla? You got a daily squeeze, you're above your 21. Oh, we got some buy signals. So that's what I like about Tesla. Like, to me, that makes it an A+ setup on its own. But the best time to take that trade as far as the probabilities is when the sector and the market looks exactly the same. So obviously the market looks the opposite. And XLY, one of the ETFs Tesla's in, not too hot, right? Under the 21, under the 50. So the best possible trade is like a 3-star trade. Like, yeah, the S&Ps, the Qs, the sector, and the stock, everything looks perfect. That's a really high probability trade. It's not to say Tesla can't break out from here. Just not a 3-star trade, if that makes sense. Now, in the event the market can squeeze the shorts, then you look at things like a Tesla that have held up really well here. They should probably lead the way. Probably get Tesla towards 315, 320 pretty quick. But there is the chance, a really good chance, that if a week from now the S&Ps are at 370, you're probably going to see Tesla trading lower. Maybe best case scenario is Tesla kind of just chops around here. So all things to be mindful of here, guys. I got to be in the options room in about 10, 15 minutes. So I'll take a look in the chat here, see if you got any questions, any charts you want to take a look at. But I do think you kind of keep it as simple as S&P's under 390. The door is wide open here for a push down towards 370, 365. And then we shall take it from there. Let me see. IWM actually did a better job holding the lows there on Friday. I don't think it lasts. But I'll jump in the chat. Let me see what y'all got. Timbo, what's up in Netflix? Yeah, so, Netflix is a good example of, ideally the market in whatever sector you would, anchor to as far as watching Netflix. Ideally, the three of them looked just as good as Netflix itself. Daily squeeze, some buy signals on the big three, like really good stuff here. But I do think the bigger question is, at least here's a question I would ask myself. I'm going to get long Netflix. Probabilities wise, what do I think happens in Netflix if the market falls back towards those June lows? My thinking would be the probabilities would suggest Netflix probably trades lower with the market. So that doesn't mean I can't take the trade, and it doesn't mean you should avoid the trade. I think that's just something really important that should be taken into consideration when you're putting that trade plan together. Do I want to do 2 times my usual position size, or do I want to do half my typical position size? Do I want to give the trade 5 days till expiration or 30 days till expiration? I think as long as we acknowledge where the market is and where the market could potentially go, and just the relationship between your S&P's puke by $20 kind of takes a toll on everything. As long as we're taking those things into consideration, then we can trade Netflix long in a fashion where if it doesn't work, it doesn't work. A lot of that pain that you hear stories about where it's like, man, I got long Netflix, then the market fell apart, and I blew my account up. It's kind of like self-inflicted pain. If you risk 1.5% of your account on Netflix and the market dies from here, you're not going out of business, right? But to me, Netflix is in the camp of something where, hey, if the market could actually trap the shorts, trigger another short squeeze, I think the Netflixes, the Teslas, things that had held up really well here, they should be they should be some of the first names out there to rally. It's kind of the way I would look at it. CJ's got Zscaler. Okay, earnings. I was going to say big pop. So the pop here after earnings does fix a lot of problems you had with your daily chart. The histogram's positive. Good for the bulls. You get your positive cross, 21 back above the 50. That's good for the bulls. And your dip on Friday, which you kind of needed a dip here. The dip on Friday held support right at the 21 EMA. That's a point for the bulls. Now, 1 point for the bears here is actually on the hourly chart. Notice how on the hourly chart on Friday, you got that negative cross. 21 under the 50. Now, it's not to say that Zscaler is going to fall apart and roll over from here. But what I've learned is you're never going to see that kind of move with your hourly chart positioned like that. The hourly chart gets a negative cross. You're not going to get that big rip until that corrects itself. Because really what it is, guys, is what triggers that move from the daily 21 EMA, like all the way up there towards 2 to 3 ATR. The daily squeeze, the daily structure kind of sets the stage. But what actually triggers that move is, trend on your lower time frames. So you got to imagine on that 3 to 4 day push, that kind of looks like it comes out of nowhere. That's really your lower time frames waking up and going into some nice trend. So here's what the hourly chart looks like during that kind of push. Positive cross, and eventually you get some buy signals. Soon as you get that negative cross, doesn't mean that things are going to fall apart. It just means under the surface, it's kind of losing some steam here. And sure enough, it got a little bit ugly. So I'm not saying from here, that's what happens. More importantly, I'm saying as far as the probabilities of getting a big pop, way, way higher if the hourly 21 EMA can get back above the hourly 50. These are things we're learning in my mastery where, one trade that we took a small loss on it, but nonetheless, these things matter in the long run. We bought the dip to the daily 21 EMA in Oxy. Like kind of the same trade you could potentially do in Zscaler right now. The trade didn't work, and sure enough, if we had checked the hourly chart before we jumped in, look at the hourly. Negative cross. What we wanted from buying those calls at the daily 21 was a big push like that. Sure enough, look at the hourly chart before and during that big push. Positive cross and buy signals. So there's the difference. That 21 EMA on a daily time frame can serve as your launching pad, but you need the energy under the surface and the structure under the surface to trigger that directional move. So I wait for the hourly to shape up a little bit more. Good morning, Monica. Good morning, Mike. Good to see everyone. All right, guys, let me check the comments here on the YouTubes. Matthew, does Amazon have a short sell trigger? In terms of where would I like to short it, Matthew? If you're asking where I would like to short it, I think you can start to work into your short on any bounce under previous support here around 125. think you want to structure a trade where you could probably sit through a bit more than that. Meaning we pop a bit this week. I'd like to start working into a short, somewhere around there. But if it rallies all the way up there towards 130, I'm not going to exit the short. So October, November, December expiration. Amazon can be a bit pricey. So a few different ways to skin the cat. But yeah, I think kind of like the way I'm looking at the S&Ps. So the thought process on the S&Ps, me at least, kind of like transfers over to everything else. Any pop under key support that we broke on Friday, I think you can short that pop. But even if we rally back above 390 or 125 for Amazon, doesn't really change anything. Like the daily chart's in really rough shape. Even a move all the way back up to 400 doesn't really change too much here. And if anything, we want to really get shorting up there at 400. Like that's the ideal spot. So for Amazon, realistically, the ideal spot would be back up here towards 130. We might not get there, but if I'm thinking of putting on a swing position to short Amazon, yeah, I'll start working into that position on a bounce towards 125, but I continue to work into that position all the way up towards 130-ish. Then you take it from there. Fly guy, good question. So, and I'll be transparent. I haven't used the Ready Aim Fire too much. But when I do use it, or the times that I did use it, it was never really so much for a focus on the squeeze. I more so use the Ready Aim Fire as far as like identifying those turning points. So a good example is, okay, NVIDIA's really oversold here. When are we getting ready for that oversold rally? Or vice versa, NVIDIA's really overbought here. When are we getting ready for that pullback? Those are the kinds of things I'd use the Ready Aim Fire for. Where for the squeeze, for me, it was a lot more about, the stacked DMAs, the 10x bars, the moving averages, pretty much everything we threw into the big three labels. So that was my experience with it. And for those turning points, the Ready Aim Fire is really, really solid. Very solid indeed. But all right, guys, that's all my time for this morning. I got to jump into the gold room here in a bit. But I hope you all found the analysis helpful. Hope you have a great week, and I'll be back on Wednesday, same time, same channel, and we'll do it again. So have a good week, guys, and we'll talk soon. Adios.